Hello, everybody. My name is Miles Clark. I'm joined here by my friend and colleague Will Gibson. How was
Yep,
your Memorial Day?
it was great.
Do any fun?
We're
Do anything fun?
yeah, oh yeah, we were at the lake boating. Weather was fantastic. I think it was like the best weather we've had for Memorial Day in years. Last year was 15 rain.
Kind of
Yeah.
gross.
What'd you do?
Actually went up to we have a
Oh
mountain.
yeah,
Yeah,
mountain
so
house.
you were out on the water. I was not. I was actually the opposite.
We sound like we're living the life right here.
Yeah,
Go to
yeah.
lake.
Well,
Yeah,
we had a bunch of family over, like 15, 20 people in a house that's probably not big enough for 15 to 20 people, but it was a lot of fun.
that's sweet.
Sorry we missed you last week in terms of a podcast. Last time you heard from us, Will and I were actually down in Florida.
Yeah,
But
at the Edge conference
yeah,
in that glass booth that completely
I
threw us
know
off.
it's not as jazzy in here, but at least we have got the Nasdaq
Yeah,
Dorsey Wright background.
yeah, we have a clean background here. Florida was good though. I like the podcast booth. I feel like since then, not a ton has transpired in the market. We were
No,
just talking about some things that we wanted to bring to your attention today. There's not a ton of things that we've seen develop. We do have some tabs that we'll run through here. I think the place we wanted to start was actually a midweek macro piece that the Nasdaq US Economist puts out, and we put it in our report every week when it does come out. And there are a couple big themes there. And one was this whole idea of like the Fab Five. So the big guys that their earnings have been growing while the rest of the market hasn't.
is it the Fab Five, the Magnificent Seven? Is
Yeah,
it is it Fang? Is it whatever it is?
there is a new name. Yeah. So they say the Fab Five is now Amazon, Google, Meta, Microsoft, and Nvidia.
Okay,
Yeah. So they're
whatever.
saying that they're saying that earnings for the AI related Fab Five, which are the names that I just mentioned, grew 85% year over year, while earnings actually fell 2% year over year for the rest of the S&P 500. So you could say that's some earnings growth concentration.
Concentration. Yeah,
Yeah,
that's how I
and
put that.
we have some more like technical points on concentration later, but I I found that to be a really pivotal takeaway from the midweek macro.
Yeah, and it's interesting because like it makes you feel like, and let me see if I can say this right. It makes you feel like earnings aren't that bad because so much of like the cap weighted indices are in
The big guys,
the
yeah.
big guys, right? And so when they're doing well on earnings, the market's doing well, but then you actually have to kind of like peel back the onion a little bit, and you're like, you actually see some like what's the word? Kind of contraction
Yeah,
of earnings everywhere else.
yeah,
So it's maybe not as good earnings season
as you think.
as you'd think. And I
Yeah,
guess then what do you say? Like those five stocks are the ones that matter. So maybe it was good.
yeah.
I don't know.
Later on in the piece, they also talked about the utility sector,
Yeah.
which has been performing very well. We were just talking, it's in the top three sectors year to date, so it's actually outperforming the S&P 500 benchmark itself. I don't think if you asked me, maybe now I would say yes, but it's like 3 weeks ago, you're like, hey, Will, what's the top three best performing sectors? Utilities would not be in my train of thought.
Yeah, I'd have to probably look far back in the Wayback Machine
Yeah.
to see the last time that communication services, technology, and utilities
Yeah.
were the top three
Yeah.
performing spider funds year to date.
There is a thread through them all. Like there's a nice fundamental thread. And again, in the midweek macro, they said it well, saying some may be wondering why utilities is an AI related sector. That's because AI requires lots of computing power. For example, Chat GPT query takes 10 times the energy of a Google search, which means big data centers and draw lots of power. So I think that's like kind of the fundamental tailwind for some of the utility stocks actually kind of riding the AI wave. But then there's also, I saw a note in here that people are trying to play the AI theme through like cheaply valued utility. So they're getting AI exposure at a lower multiple.
Sure.
Sure. Sure.
Let's just go with that.
Sounds nice on paper.
Yeah,
We're chart guys. Like if the chart gives the follow through and you get some good momentum, we'll go with it.
right.
So I don't know. I just thought that was
Yeah,
pretty
there's
interesting.
something maybe there. I mean, the idea is that all it takes is maybe playing roulette and seeing if the guys will mention AI on their earnings call.
Yeah.
And maybe the stock is up 10 or 15%.
Yeah.
Who
It's
knows?
crazy.
So we'll, I guess, wait to see because you'd think like I'm the crypto guy, I guess the self-imposed crypto guy in the office, but you'd think like there really wasn't that much of a utility play on Bitcoin, and
Yeah.
there's a lot of energy there. That's more on, the computing power and
Mhm.
blockchain and everything like that. But you didn't really see that translate to utility gains, but you are seeing it for AI. So who knows what the deal is.
I'll let you hash that out. All right, next piece that I want to highlight. This was in the report this Tuesday. Joseph wrote it talking about just market concentration. We kind of led the call with today with some of the earnings data points, but the S&P 500 market concentration is at multi-decade highs right now. I think people are all concerned about the top 5, top 10 stocks in the S&P 500 having such a big say. JP Morgan had a nice chart. They talked that the weight of the largest 10 stocks in the S&P 500 is currently 32.1%. The weight of the largest 11th through 50th stocks is 34.9. So you can see their chart. We'll put this on YouTube, but just the degree of market concentration, I think, is troubling for some. Of course, like active investors, that's troubling. If you're a passive indexer, then I guess whatever. But for active investors, I think it's a bit troubling. For stock picking, it's a bit difficult. We've talked about our core rank on the platform, that S&P 500 funds group is like in the 98th percentile. Like nothing's
Yeah.
scoring better right now.
And it's been there for
Ever.
quite a while. Like
Longest ever, I think.
Joseph talked about all of the great research he's put together. He wrote another piece that was talking about the length of time that average S&P 500 group has been above the 97th percentile, right? And it's the longest time in history, of
Yeah.
course, right? So I mean, there's this idea that the core of the market, it kind of sounds like a broken record, but like the core of the market is just the place to be, right? When you have the cap weighted guys, the Fab Fives, and they're accounting for 32% of the index, and they're doing well.
Yeah, I mean, it's kind of the hand that we're dealt right now, and that's the game that we have to play. We
Yeah.
can scream all we want about why this shouldn't be the case, but if that's what's working for the market and that's what's delivering returns, then that's where trend following is going to have us. So it's maybe frustrating, and we don't know how long this is going to go on. It can
Right.
go on much longer than you'd think.
Yeah. And we're also certainly don't want to give the message that like this is some type of doom and gloom. Right?
No,
We saw the market in 2023 before things kind of started to broaden out a little bit. It was pretty concentrated in, I guess at that point it was a Magnificent Seven before Tesla kind of fell out of it. But we've seen concentrated markets before, and they've gone on longer than you expect, right? So now we've got two less guys, two less guys in the name. But that's certainly not to say that we're anticipating some type of massive pullback.
Right.
So
Right. Anyways, all right. Next thing, I want to just highlight 2 commodity bits, and then we have two other things to conclude with. The copper and gold relationship has been really important as of late. I think I actually mentioned this when we were in Florida doing the podcast there.
Yeah.
But copper got back to a buy signal versus gold. So that's just some point and figure jargon to say that we've seen an objective change of leadership between copper and gold prices. Copper prices gave an RS buy signal, a relative strength buy signal against gold. Historically, that's been good for markets. Copper, broad economic use, gold traditionally a bit more defensive. And we put a piece in our report talking about this. It typically runs with interest rates. So when copper is outperforming gold, rates tend to move higher. When copper underperforms gold, you typically see rates fall. And there's a lot of economic ties there. But if you look at times when copper was on a buy signal against gold, the S&P 500 averaged a gain of 29%. When copper was on a sell signal against gold, the market averaged a return of 9%. And there's some big outliers in there for sure. And there's been periods where copper was underperforming, but the market fine. So yeah, there is that. But based on the averages, this is probably a good sign.
Right. And not only, I think in that same study, not only is it good typically for domestic markets, but you also have impacts on international markets.
Yeah.
I won't say impacts. I'll say historical tendencies.
Oh yeah.
Internationally as well, right? You look at Latin America, parts of emerging markets, China specifically, you have some preferences for copper versus gold there too. So
yeah, that's a great point. Yeah. So I think that's something to really watch and put on your radar. That's a big development for us. I've heard some people kind of throw some caveats like, well, copper's in backwardation, which means that the future prices are lower than the current price, which means copper would come down. And people have talked about the inverted yield curve, kind of similar story there. So Sure, there might be some qualifiers here, but again, based off the weight of historical data, this is probably probably a good thing.
Yeah, and I'll also add that chart, it tends to trend.
It
too,
does,
right?
yeah.
So it's not like we're sitting here and saying, oh, we returned to a buy signal and then it's kind of too late. Like at
Mhm.
least historically, buy signals or long-term strength has led to more buy signals in
Right.
favor of either copper or gold.
Yeah.
Right? So we just returned to a buy signal. You
Favoring
know,
copper, yeah.
yeah, so that would say, okay, well, there might be more
Yeah,
buys, the upside participation isn't quite necessarily done yet.
yeah.
Yeah.
All right, this was just a passing data point. I just had to mention this. I put this in the report yesterday. Silver was up over 5% on May 28th. So SLV, the iShares Silver Trust, was up over 5%. That was a 99th percentile daily move, which went pretty quiet, So 99% of the time historically, silver has not moved more than that in a single day of trading. I don't have a ton of application before that, other than that was a wild data point over the past week.
Yeah, I'll have to go into my closet. I got a bunch of old coins in there.
Oh, you got some of those silver coins?
Yeah, yeah, just like some of the commemorative coins every once in a while. So it seems like it's doing well.
Yeah. Go to
But
somebody and
but
melt
that
it down.
SLV chart is actually pretty convincing. When you look back at 2023, you saw $23, 23 and a half as a really stiff point of resistance there.
Yeah.
You broke past that, then you put in some support at least to open up May of this year, support above that range. We can get super technical and by talking about support and resistance. The point is that you've now established yourself above points in 2023 where we couldn't get past before. And so there's definitely more than just technicals in play about these precious metals and commodities in general.
Mhm.
But yeah,
Yeah.
I mean, technically it looks strong still.
Totally agree with that. All right, maybe a contrarian point, and I'd be curious your thoughts here. Volatility has been really low.
Right.
I mean, concerningly low. I would say the VIX hit a 9-year low, I think, at some point. Charts at the lowest level, at least matching its lowest level in 8 or 9 years. So expectations for future volatility are pretty low. I know we've put in some pieces in our report talking about the VIX explicitly, and then also the VVIX, which is the VIX volatility.
Volatility of volatility.
The volatility of expected volatility. So, I mean, both of those are at really historic lows. I think if you are looking for a kind of bearish contrarian point, I think that is one. You typically don't see it hang out here for super long.
Yeah, it's ticked up a little bit, at least as of today, it looks like, or that was,
I don't know.
I don't know.
I don't know. Anyways, very possible that we get a bit of a VIX mean reversion, which could be a bit of a pullback for markets. All would still be healthy and within the realm of normal.
Right, and you have to take yourself back to April, talking about healthy.
Right.
If you go back to April, you saw technology take a bit of a breather, semiconductors take a bit of a breather. And we were saying on our podcast, hey, this is still healthy, right? This is good. So, kind of taking the weight of the evidence, looking at your different indicators, looking at the, VIX, for example, and saying, all right, there's maybe some weight that would say we're in tune for a bit of normalization here. Certainly not a bad thing.
Yeah, no, it's so hard to time those things. I was talking to someone yesterday. It's so difficult. Market tops are disguised. They all seem different. They behave different. They look different. So it's really tough to time those things. Something else I was going to mention too is that this is an election year. We're coming into the summer months. Typically, summer months are a bit weaker for the market. And I think maybe the closer we get to election and before the market gets that clarity and that certainty, maybe there's some qualitative reasons that we do see volatility pick up there. So not to try to make a story to fit the chart, but maybe that could be a bit of a story.
I could see volatility spiking either way. I don't know. No calls there, but
yeah.
But November could certainly bring some extra volatility.
Yeah. All right, not too much else on the radar that I had. Interest rates, I don't think I've done a ton over the past couple of weeks worth talking about. I mean, market continues to kind of punt those rate cut expectations. So
it seems like, just zooming out a little bit, it does seem like eventually the cows are going to have to come home. Like, let's think about it.
Yeah, walk that up for a little bit.
Like, it just seems like we're gonna have to, thinking about where expectations were to end 2023, right? And you were gonna get cuts pretty early in 2024. Those didn't come. Inflation stuck around a little bit longer. market really didn't seem to care that much. Then it was like, oh, well, maybe it'll be kind of around the summertime. And then those kind of came and went a little bit and
Mhm.
hunted it down further. The point is that like eventually the market's gonna have to deal with maybe things being higher for longer than we would have liked.
Yeah.
And who knows how that's gonna be digested.
Yeah, I actually made a point on the on the copper gold relationship is that this is kind of tangent, but seems like the market wants a soft landing more than it wants rate cuts. So if we can get the soft landing without having to slash rates, I think that's best case possible here. And I don't think we should be cheering for rate cuts and hoping for those to come.
Right.
Is kind of my point there.
Yeah,
So
I think that makes
if
sense.
we keep punting those, cool.
Right, because essentially
are
what that's
good.
saying, we don't need to cut,
Right.
like things are still somewhat comfortable.
Yeah.
We don't need to cut right now.
Yeah.
Let's wait a little bit.
I agree. So just to kind of have a rate story, there's always a rate story. Those Fed futures market expectations ping around all over the place. The September probabilities, I think, are like 50-50 right now between a rate cut or no rate cut, but that could change by the time this podcast comes out. So story is still to be that rate cuts are continuing to be deferred. And summary is stick with the charts, stick with the data. Stories sell, but I think data is what drives the investment decisions at the end of the day.
Oh man, you practiced that one?
No, I didn't actually. It's the first time I've ever said that.
Oh, well, it sounded good.
Yeah.
Sounded
All
good.
right. You got anything else?
I do not have anything else for this week.
Cool. We can wrap it up. Appreciate the time, everybody, per usual. One of us will be on next week.
Yep. Appreciate it. Have a good one.